Hopefully, if you don't understand anything, you will be able to review the video at some point. Okay? So today we shall talk about what we call a 3-bar reversal pattern, or the 3-bar reversal patterns. In Forex, this is very common because we find that the market always moves in waves. Okay, so the market moves up, then retracts, then moves up, then retracts, and then depending on the volatility in the market, it might move up and then starts playing around, not as high as before, and then suddenly it changes direction, goes down, then goes up, goes down, then goes up. Okay, so this is what we are saying reversal. All right, now if it was coming from up, down, up, down, up, then something happens in the market, it decides it's done going down, and then what is it going to do? It turns around and starts going up now. Okay, so again, this whole area here, all right, is what we're saying. So the market can reverse. So it's coming, going up, then suddenly it decides it's going to go down. Okay, or in this case, it was going down, and then it decides that now it's going to go up. So basically, it happens a lot in the market. It happens in the big time frames, in the small time frame. Okay, but it's very, very common when we have what we call a trending market. So trending market means it was going up for a long time. Basically, it was bullish for a long time. Okay, we said we know what bullish means. It means the market is going up, or people have been buying or going long for an extended period of time. Okay, so very typically you'll find that that will be like that for a while. Okay, so in Forex, we try to look at the market structure and try and figure out at what point will this thing now change? Because especially if you enter the trade here, okay, and you're literally just making those pips, then you have to be careful at what point you get out before it suddenly decides that now it's gone up enough, now it wants to go down. So we always have what we call the telltale signs, the signs in the market that actually can tell you when the market is about to reverse. Okay, and that is what we call a 3-bar reversal pattern. So you will see that the patterns in the charts will start behaving differently from what you are knowing. So on an uptrend, we know that the market comes from a low to a higher low. Then it goes down to a higher low. Okay. Sorry, a lower low. This is a lower low, not a higher low. Oh, this is a higher low actually. Then it goes to a higher high. Sorry about this. Okay. So this is higher low and this is a higher low. So when market is trending, you have higher highs, and higher lows, and higher lows, a series of them. And then suddenly, the market decides that now it's starting to change. Our focus today is in trying to figure out at that point when it's changing, is there a pattern that it forms? Is there something that we can look at in the charts that can tell us that the market is changing? Well, the answer is yes. If you look at the last couple of days, we've been sharing a lot of candlesticks. You can look at the candlesticks and you can tell when it is changing. So how do we do that? Okay, this is what we do. So first, the candlesticks, we have to understand the movement of the candlesticks, and I think we've done that several times. So we know that a candlestick forms if the market is going up. Okay, it forms like this. Okay, so usually that is the opening, opens there. Okay, then it comes down. This is the lowest it reaches. Okay, lowest price it reaches, and then it plays around here, hits the highest price. Okay, and then it closes there. That's the closing price. Closing price. So this is open price. All right. Now, when it's forming, the next candle, it forms from the closing price. So you see another candle starting to form there. So depending on what's going on in the market, goes up, goes down, might even still come down a little bit. Okay. And then okay, there. So then, of course, this becomes the opening price, even though it was the closing price over there. So this becomes the low it reached, low price. This is the open price now, and this is the closing price. But please note that essentially the candles are almost neck to neck. Okay, one finishes, the next one forms. The next one starts, the next one forms, like that. Okay? And of course, they're not always the same size. Of course, some are smaller, some are bigger. And I'm deliberately ignoring the wicks. The wicks are there also, so don't forget the wicks. The wicks are there. And the wicks show the opening and closing. All right, so that's in a up move. But when the market is bearish, which is going down, the opposite happens, which means that the candle forms the opposite way. Okay. So now, because it's going down, this becomes your opening price. All right. This becomes your closing price. This becomes your highest price reached. And this becomes your lowest price reached. Meaning that in the next candle to be formed, it will be formed right after this, but on the right hand side. So same thing will repeat. You'll repeat the same thing. Okay. And so on and so on and so on. So because now we know the candle movements, how they are formed and so on, then how do we recognize when we are actually entering a reversal? Okay, and that is our topic for today. So please, if you have questions, keep them to the end so that we can then ask questions accordingly. All right, next slide. Okay, so here I have three. Uh, Again, my art is not very good, but at least it'll explain the point. So let's assume that this market actually is reversing, it's going upwards. Okay, so it was coming down and then it's going up, coming down, then it's going up, coming up, this going up. I think there are other options here. Let me see if did I cover them. Oh yeah, there's one more. Okay, so we're going to introduce some new terminology here. Okay, so at the point where the market looks like it's turning, okay, we count three candles. One, two, and three. So the first one is what we call the measuring candle. Now, other people might have different terminology, but that's the common one, measuring. Why? Because it measures and determines whether the market is going to go up or not. Measuring candle. The second one is the apex. Apex. Oops. Sorry, my handwriting there is not good. Anyway, you get the idea. Let me see if I can erase this. Okay. So the apex candle. And the third one is the trigger. Right? Meaning that when this is forming, okay, you'll probably just see candle one, two, one and two. Three will not have formed yet. Okay. When candle two behaves this way, then you know you are starting a reversal pattern. When at the bottom, it's about the same, oops. All right, I don't know how to do that, but you get the point. So one, two, three, where the first one is the measuring candle, measuring. The second is the apex, and the third one is the trigger. Now, if the market is on a true reversal, then your biggest your task is to make sure that your apex candle, when it is forming, must close above the measuring candle, must close above, oops, oh, disappeared again. Okay, sorry, keep losing my drawings here. All right, so one, two, three. So the important thing is to note that this candle, the apex candle, must close above, okay, the measuring candle. As you can see, this is where it has closed. So typically, once it starts flickering up there, okay, you start getting ready to enter your trade. And ideally, in terms of entering your trades, then that is the place you enter. At that point, you enter a buy or a long. Okay, after the apex candle. Why? Because it has closed above the measuring candle. So we always try to measure, okay, where it has closed. Measuring candle. Uh, 2 is the apex. And 3 is the trigger. Okay, second example is when it comes, okay, again, on the same level, all right, and then this one, there's no drama. What it does, it actually refuses to go over. If it refuses to go over, whereas this was initially your measuring candle, this was your apex, all right, then what happens is when the third candle begins, then you ignore this one. You ignore this one, candle number 2. So it's like it didn't exist. Why? Because it's the same size and length as that one. So really, this is 1, 2, and this becomes your number 3. Now, please note that the fact that this is not there means that this becomes your apex. And you only enter the trade when it closes. And it's supposed to close above our measuring candle. Supposed to close there. So the fact that this is here and it's reversing long, okay, and the same size as the measuring candle, then you ignore it, you don't count it. So then you only have 1, 2, and 3. So then your entry is actually at the end of the second candle. Okay? Why? Because sometimes you'll find this candle here, the apex candle, that was supposed to be apex, then they form very many. They can have very many of them. Okay? And then suddenly it breaks, it continues down. So it becomes a continuation, not a reversal. So for you to know that you do have a reversal is when the next candle forms and closes above the measuring candle. So we don't care how many of these candles are there, how many of okay, how many of the apex candles are there. They can be for as many as will form. You don't care. All we think is as long as they don't close above, if they're the same size as the measuring candle, then it's not a reversal. Which means, of course, then if a candle comes and now closes down there, then the pattern is null and void. It is not reversing. In this case, it is continuing down. Why? Because now this one has closed below. Below what? Below the measuring candle, which is candle 1. All these are the same as candle 1. Okay? So this is null and void. It is not a reversal pattern. But if the reversal, it must close above that one. All right, we'll see other examples here. Number 3, so this is first example. This is example 2. Example 3, something is happening differently here. All right, so it comes, the market comes down, stops, okay. The bull candle does not close above. So this becomes our initial measuring candle, and we are hoping that this one will actually go up above that one. And the fact that this one has not closed above it, so again it becomes null and void. Then this becomes our apex. Okay? So when it closes above the measuring candle, then you go in. So you don't enter here. Why? Because here, this candle is still bigger. All right? So when this formation forms, you have to wait for another candle. And this candle must form and close above the measuring candle. So then your entry would be there for the long. Okay? So that's example 3. Now example 4, a little weird because anything like this happens in the market. So it comes down, is a measuring candle. Then the apex candle is like a giant. It actually overshadows this other candle. So ideally, if this is candle number 1, this is supposed to be the apex. Okay, we are supposed to enter at that point if the market is going up. But instead of going up, it comes back again. So again, this is null and void. It is not a reversal pattern. Okay.
We cannot see candle 4. Cannot
Oh, you can't see candle 4.
example 4. Yes.
Okay, let me see what's happening here. Is it for everybody or just everybody can't see candle 4?
I think the space there is the working space is limited. So
Oh, it's limited. Okay. All right. I'll see if I can move it down. See if I can move it down. Okay. Oops. Okay. I'm going to move it down. Can you see it there?
Yes.
Okay. All right. So here, what I was just trying to say is in the 4th example, the move up has been nullified by this big bullish candle. Instead of it closed up, yes, but the 3rd candle instead went back below. Let me see. So that's the measuring candle, the apex. All right. The 3rd candle, instead of entering and going bullish, instead chose to come down. So this is not a reversal pattern. So when you see that happening, then clearly, and especially followed by something like that, then you know that the market has not reversed. It has not reversed. Instead, it came, paused a little bit, and then now going back again, which is very typical. The market will go like that, like that, like that. Okay? Whereas this one was like that, then like that. This one like that, like that, and then like that, and then continued. Same thing. All right. So those are reversal when they're going upwards. When you're going downwards, the same thing happens. The same thing happens. Okay. So I guess just think of this upside down, upside down. Same thing happens. The only exception that I wanted to make was uh, when the candles come, okay, and then, oops. So if this is candle 1, this candle 2, then candle 3 instead decides that now it's just going to be sitting here on the same line as this one. Again, I think I gave an extended example of that. Assuming these are all the same, if they are all the same, and this apex candle is actually bigger than all of them, okay? As far as the reversal pattern is concerned, even if this candle here decides now it will go up, then all these things, the ones in the middle, they don't count. They don't count in your reversal pattern. So this becomes candle 1, 2, and this becomes your trigger. So you wait to enter there. Okay. And the same thing when it's going down. When it's going down or going up. So everything I've just said applies when it's going up. Oops. So for as long as they are the same, there is nothing going on. But the fact that then suddenly it decides that now it will become bigger, close bigger, okay? So this becomes the number 1, then all these ones here don't count. So that becomes your measuring candle, this becomes your apex, then at the entry of the next one, that becomes your trigger. Okay, where do you see this? Well, you see this a lot, especially during breakouts. During breakouts, okay, especially these ones, this kind, all right? But these ones normally at the tail end of a long, like a trending pattern. If it was trending long, okay, or trending short, usually at the tail end there or at the bottom, that's where you're likely to see this kind of patterns. And when they happen, then you know it's time to start changing your trades. All right. So I will recap on what I've just said. Then I'll open it for questions. Okay. And if we go to the chart, the charts, you will see a lot of this. Again, in the charts, they don't form like 100% perfectly the way I've drawn them here because they always have the wicks. So sometimes they look a little weird, but the principle is the same. Even if they had the wicks, then you will consider the wicks. You will consider the wicks, all right? So here I'm just drawing them because that's technology for us. Okay, but even if they had the wicks, the principle still applies. In other words, you look at it in terms of the size from the beginning of the wick to the end of the wick. Oops, trying to draw here like that. So if this is the wick, then that's the candle, that's the candle. So you consider the wick as part of the candle. All right, three-bar reversal patterns. Why are they important? They're important because if you're having, if you are on a long trade, okay, or on a long buy, and you are wondering at what point will it now start turning against me, chances are this will be your signal to actually start shifting your trades. All right. There are other candles that specifically tell you, but I will not get into that for now. Just for now, this is just a simple strategy that will give you a heads up. When you see the three-bar reversal patterns, it means you are getting ready for a turn or a turning point. Okay. And for that, I think we're done with the class. Let me get to the charts just in case there are visible examples we can see while you prepare for your questions. All right. Like I said earlier, that okay, there we go. So if you look at a chart, and this you can do your own back testing. You can go and zoom. Okay. And then look at places where there was like, in this case, let's look at this one first. There. So this is a, oops, sorry, not sharing. Oops. Sorry, I forgot I was not sharing. All right, now I can share. Okay. So I'm sharing a live chat, a 5-minute chat, and let's see if we can find these points, these reversal points. So if we didn't know, if we hadn't known how the market was moving, okay, please look up here. So this chart has formed. All right. So we are looking at this. Okay, let us see what happens. So when the market comes and it does that, okay, already the fact that it has closed the same, it gives you a heads up. So that can become our candle number one. Okay, it gives you a chance to say, okay, this is forming something interesting. So that becomes our measure number one. Okay, then remove the next candle. The second candle has closed below, but has it crossed the measuring candle? Sorry, has it? This one here, sorry, this one was a marker. All right. So at this point, sorry, this was actually the first one, the measuring candle. That's the first one we use for measuring, which means if it's going to turn our second candle, the apex, okay, that's our second, and then our third one. Has our third one closed below the measuring candle? No, it has not. So we ignore it. In other words, we cannot enter a trade based on this. We have to wait for the next trade. Okay. Now let's see what happens in the next one. As long as these candles are going to form here, the candles, as long as they do not close below this one, then we cannot say that this is a true reversal. So we wait for the next one, and there's the next one. Okay. But what has happened? The next one has not closed there, but the fact that the wick has actually gone down, it means this could be a trigger, okay, because it's trying to go up. But again, for safe trading, you don't trade it. You wait until it is below this one, okay? So is it down yet? No, not yet. There. Now this one has closed below. So it took like almost 4 candles. Somebody might argue that why couldn't we just take the trade? Well, if you're a scalper, yes, you could have gone down. Okay, it's a bit risky, but for most normal traders, they would wait until they cross that line, which in this case, this one has just crossed. So this is your trigger. When it closes there, then you enter there. So this is your first candle, then this is your second, and then the third one is the trigger. So the first one is just a measure. This one tells you below what level or above what level do we enter, okay? And then the second one must close above or below that level. If it was going up, yeah, but in this case, the reversal, it has to close below. So it has closed below. So now you enter, all right? Okay, and then what would have happened on that trade? Yes, you could have gone and taken some profit there. So you entered here, and now you're going down with the market. Chances are it would probably come and retest that or that level over there. Okay, there, see, it actually went all the way down. So if you had entered the trade, you would have made some, I don't know how many pips. You'd have entered there up to there. That's 9, that's 10.54 pips. All right. So then it is attempting, to reverse again. Again, same strategy. You pause, okay, and identify which is your measuring candle. If indeed it's going that way, then this could become your measuring candle. Okay, I mean the first one, measuring candle. Okay, then the second one could be your apex. Then the third one, let's see what happens. Ah, it didn't do anything. So again, this would be a tricky trade. You don't enter it because it looks like it's just gonna play around there for a while. So then this is nullified. This yellow candle here is nullified. So that one is nullified. Okay. Again, so there's no proper turning. Okay, here, this, but this we cannot say is a turn. Why? Because now we'd be looking at this first one here, which is the measuring candle. Okay, all these little ones here don't count. And so this one is attempting to come back above the measuring candle. Let's see what happens. Nope. So all these candles here are neither breaking the high or the low. So they are preparing for what we call a breakout. So if you're a scalper, then you get excited. When this happens like this, and you have a big candle there, you get excited because you know eventually it will break. Your breakout will be based on this candle here. And at that point, you can draw a rectangle like that. Oops. That color is not very friendly. Okay. I'm making it a white. Okay. There. So let's see what happens. Okay. It's now ready to break out. So this would be a good opportunity for a breakout trade. Eventually, it will break out from this box, I mean, from the rectangle, either down or up. But if we were to measure in terms of reversal, we would expect that the next candle should have closed above the rectangle. But if it doesn't and keeps going down, it means that it is not a breakout, it's a continuation. But either way, as a strategy, right here, you can put pending orders. You can put pending orders down, pending orders up, which means as soon as it breaks here, it's going to go up or down. And either way, you're going to be in the trade. See, it's gone down. All right. So if it's going down, if you had a pending order below the wicks, then the idea would have been to go for 10 pips, 10 or 20 pips, depending on the time frame. So for 5 minutes, 10 pips might be a bit of an overkill. All right. So you have to probably go for 15 time frame or 30 minutes. Then that is better. But for a small time frame like this wicks will actually mess you up. So anyway, so here there's no continuation, rather there's no reversal. Instead, it's a continuation. Okay. So whoever had gone here for a 10 pip, breakout there would have made some money on the way down. All right, reversal. This is this a true reversal? Well, let's look at it. That's the measuring candle, number one. That's the second candle, which is the apex. Now, the trigger did not close above the measuring candle, which means it is not a reversal unless the next one closes above. If the next one closes above, then that's fine. Nope, it did not. So we are still stuck there. Another opportunity for breakout. Whenever you see these candles being closed into a rectangle like that, it's an opportunity for a breakout. Again, if you look behind here, there's some space. You can measure and see how much space you have there. Between there and there, that's what? Only 2 pips. Now, this would be a dangerous trade to enter unless you're measuring 10 or 20 pips above that or below that. Okay, because of the support you have there, and then another layer of support. So when there are many layers of support, you don't do a breakout. Okay. All right. I think the examples are clear. Okay. This market keeps going up and down, but for you, you can practice this later. You can go at the charts and you can press F12, F12 or the right arrows. You can move the market, to the right or to the left to kind of, it's called backtesting, So this is a strategy you want to use. You try and say, okay, fine, does this thing happen often? If I was to enter here, okay, because it's coming down, like here now, she would have forgotten all this and said, okay, fine, because of this, I'm going to enter here. Okay, would I have made any money? Or if this is a reversal pattern, okay, you'd back test it. You try and move it one, click by click to test the idea. And if the idea works, then you try and trade it. Okay, again, I don't want to make the video very long, so we'll pause here, we'll stop here, and we'll take questions.